Welcome back to a series of videos that I'm making to help you understand a little bit more about infinite banking, what I like to call the investment optimizer. Today, we're going to talk about a commonly asked question, which is, what are the benefits of an infinite banking style policy? More often than not, the reason why people are coming to me to structure these policies is because they're an alternative asset investor, or they're going to start being an alternative asset investor. Now, let me define that. An alternative asset investor is simply someone who's investing in non-traditional methods. Usually it's going to be real estate, multifamily syndications, different kinds of funds, self-storage funds. There's a lot of different kinds of alternative assets. Even somebody's own business or practice as a physician would be considered an alternative asset. Traditional market assets would be a 401k, an IRA, a brokerage account, just a traditional method of investing. Now, typically when somebody is investing in alternative assets, they'll have what I refer to as an opportunity fund. And this is simply the place that they store capital until they're ready to deploy that into an investment. This place that they store that capital usually ends up being a checkings, a savings, or a money market account because they need it to be safe, predictable, and liquid. And what will happen is when they store up enough capital in their opportunity fund, they'll deploy that capital into investment, maybe $25,000 up to $100,000 increments. And then as those investments pay out or produce some sort of cash flow, they'll take that cash flow and they'll replenish that opportunity fund so that they can build it back up and repeat that process and create more wealth and invest in more assets. Well, all we're doing with an infinite banking style policy or an investment optimizer policy is replacing that opportunity fund with a much more efficient account, which is a max overfunded dividend paying whole life insurance policy. The benefits of this is that you're going to get a guaranteed 5% return inside of the policy. Now, money market accounts right now are paying close to 4 or 5% in a lot of areas. However, has that been the case for the last 20 years, even the last 100 years? The answer is no. And in a life insurance policy, 5% is actually on the lower end of what they're typically paying. So a max overfunded dividend paying whole life insurance policy provides a guaranteed 5% return that they can count on. It's safe, predictable, and it's liquid, which are the makings of a great opportunity fund. In addition to that, another benefit is everything coming out of the policy comes out tax-free, whether that is loans for investing, whether you're taking it out as pure income, or if the death benefit pays out, all of those methods are going to pay out tax-free money. One of the biggest reasons why people love these kind of policies is because of the loan provision. You have the ability to take a loan on the insurance policy to invest and create wealth and really do whatever you'd like with, but the majority of what we're doing is creating wealth. And the benefit is your money stays in your policy and continues earning compounding interest. So very literally, your money starts working for you in an investment that you put it in, and it keeps working for you in the policy. So the same dollar is working for you in two different places at the same time. Once somebody gets to a stage of life where they're slowing down on their investing and really just turning into a more retirement phase, you can actually turn this policy into an additional stream of tax-free income. And it can pay out similar to like an annuity, where you can just count on that income being there because of its guarantees and predictability. In addition to this, depending on the insurance company you're working with, most of the insurance carriers have a long-term care rider on all of their policies. The insured on the policy is able to use the death benefit early to pay for any sort of long-term care, whether it's in their own home or in a facility, as long as they meet the requirements for long-term care, which is they cannot perform 2 of the 6 daily activities of living, or they have a cognitive impairment. Either of those will allow them to access the death benefit early to pay for long-term care. Another benefit of this policy is that it can act as a volatility buffer for your stock market investments. Or in other words, it will be able to extend the life of your other assets that are invested in the market, because when your market assets are down or you have a negative year of returns, you don't have to pull money from those accounts. Instead, you'll pull income from your life insurance policy and allow your account to recover. By doing this, it can extend the life of your other investments by 10, 20 times. It's actually pretty amazing once you start looking at the numbers. And lastly, it is a life insurance policy, so there is going to be a death benefit. That death benefit can provide a legacy for your heirs, or it can also help with equalizing your estate and making sure that money is distributed equally to everyone, especially if there are different assets involved. And lastly, if your estate is large enough where you're over the estate tax exemption limit, the life insurance can come in and help preserve the estate, because now your beneficiaries don't have to sell off assets like a business or real estate. They can utilize the liquidity from the life insurance to pay for that estate tax, preserving your estate and making sure that all of your assets stay intact. I hope you found this video helpful. Make sure to give it a thumbs up, make sure and subscribe to my channel, and if you have any questions or comments, drop them in the comment section below. Make sure to turn on that notification bell, and we will see you on the next video.